how much can you contribute in solo 401k if you have 1099 income, no C Corp or Corp as a consultant? Can you do employee and employer contributions both?
So you can have an element of both, even though you're not an employee of your own sole proprietorship, but there is a calculation. I won't go through all of it, but basically it's the net profit minus 1/2 of the employment tax, and then you divide that by 25% or 1.25, and then that gives you your overall maximum. There's the maximum that the particular year is allowed, which is I think it's $66,000 for 2023. But if you have anything below that from your maximum calculation from your net profit, it's going to be the lower of those two numbers. But directly to the question, yes, you can. And yes, there is an effect, both contributions, even though you're not really an employee, but there are a profit sharing portion and an employee contribution deferral that you get to do through the calculations. But the overall, I think it's $66,000. I want to say it's this year. As an individual, it's $22,500. Unless you're over 50, then it's another $7,500 for a total of $30,000. This again is 2023, not contributions for if you're doing your 2022 returns right now.
And you still get that add-on even if it's the 66. So you could be what, 73.5?
Correct.
Like
yeah, total max 73.5.
If you're older than 50 or older, right? Or is it?
Yes, sir. No, over 50.
Over 50. So if you're 50, you're toast, or if you're 50, you
I'm sorry, it is 50 or over, I believe. I'm actually not sure.
I think yeah, whatever it is. So you talk to your tax professional, right? We'll look it up. It's either 50 or older or over 50. I think it's 50 or over.
Just get to 51, you're safe.
Yeah. But this is always kind of an interesting thing. I tend to look at it and say, if you're going to be you should be taking a salary. I don't like doing these solo 401ks on a sole proprietor. Number one, because sole proprietors statistically are more prone to be audited by a multitude. It's like between 800 and 1,600% more likely if you're making decent money, 100,000 a year or something like that in a sole proprietorship, your chances of an audit are infinite. Like at this point, it was literally below 0.05%. It was like less than 0.5% if you were an S corp. And you're still looking at around 1.4% as a sole proprietor. So I don't even know what that number is now. It's a lot. It's more than 1,000% higher. And the problem that I have is that the win rate, the change rate was in the mid-90s the last time they gave us the data, 94 to 95% when it was sole proprietors. So what I believe happens is your requirements for maintaining good books and records as a sole proprietor is the same as if you're an S corp or a C corp. But there's a myth out there that there's less formalities as a sole proprietor. Oh, they're easier to run. You don't have to keep as much paperwork. That's what they smack you with, because with the IRS they don't care. There's no difference between them. It's books and records. You have to keep good books and records. If it's a sole proprietor, it's the same as if you're an S corp, same as if you're a C corp, same as if you're an LLC taxed as an S corp or LLC taxed as a C corp. So yes, you can do it, but I wouldn't. If you are making good money, if you're making any money, but definitely if you're over, let's say, $30,000 a year, the tax savings alone just from the employment taxes. So let's use Elliot's example. Let's say you made $100,000. You would owe old age, disability, and survivors and Medicare on the full $100,000. That amount would be 14.1% when you factor in the deduction for half of the employment taxes on your return. So the net, like, you're going to end up paying $14,100 in employment taxes. Yet say the employer contributes $25,000 into your plan. You wouldn't owe federal income tax on that, but you still owe the employment taxes. Hey, I'm deferring $22,500 into the plan. Now it's going to lower the $25,000. Like, we'd have to do the math on that. But that also, you still have the employment tax. If all we did was set up an S corp and run the salary out of the S corp, let's just say that we ran a lower amount of salary. Let's just say that we ran $30,000. We would be able to still do the $22,500, but we would save $10,000 in tax, thereabouts, just right around that mark. On $70,000, it would be right at about $10,000 bucks that we would save just in the employment taxes. And I know I'm going to have somebody scream and say, well, but you can't contribute as much. Then make an after-tax contribution, right? Because you saved more than you would have saved had I done the just the 401k contribution. Or worst case scenario is pay yourself $100,000 in salary and do both. And you're no worse off, except your audit rate just got shrunk by a multitude, right? So I tend to look at it a little differently. I'm not a big fan of sole proprietorships. I just see them get tased and they lose all the time. It was quite literally, last time they published the data, it was publication 55, it was table 17B, and they've stopped publishing it as of about 2 years ago. But they would actually tell us, here's the audit rate, here's the success rate from the service. And it was quite literally 94 or 95% success rate. And you're like, oh, Jiminy Christmas. They're just tasing these people. 70% of the businesses out there look just like that. Don't want that. Don't want that.